Hey everyone, welcome back to the Mark Loeffler Experience. Today we're going to go through RBC economics, global asset management. I went there and listened to these guys for an hour, and I'm going to condense this all into about 10 minutes of fun for all my YouTube family out there. If you haven't, please like and subscribe. It really does help the channel. And you know what? Go back and watch a couple hundred videos. You know, that always helps too. There's some good stuff in there, some great content. Watch some economic stuff from last year. See how right I was, see how right they were, and let's go from there. All right. So economic scenarios over the next year, so 2023. So they're saying that if inflation normalizes, there's a 25% chance of there actually being growth. So the economy growing more than zero. If there's persistently high inflation, there's a 5% chance of growth. They're calling it the fabled soft landing. You've heard me talk about the soft landing here, and this economist that we saw here was really, he thought that we were going to hit the soft landing. He thinks that they think there's actually an 85% chance that inflation falls and we hit the soft landing. So not a huge recession, or even some growth. 60% chance of recession. So overall, there's a 70% chance of inflation. In their mind, a recession isn't their ideal, but this is what they're willing to do to obviously tame housing and inflation and economic excesses, as they call them. And then there's a 10% chance of the inflation continuing and you have a recession. Anyways, it's a nightmare scenario, as they're calling it, because then we'll need to increase rates even higher, which will stall the economy greater, which will lead to a longer and longer recession. Here are the recession signals that they watch for. So the 2 to 10 year curve inverts, the 3 month to 10 year inverts. These are bond charts. Fed short-term curve inverts, inflation spike, oil shock, financial conditions tighten, jobless claims jump. Something that hasn't happened yet, monetary tightening cycle, but there is. So there's less money out there now than there was, obviously, and there was just free money there for a long time. Google recession news trend. Yeah, that's one thing that's not happening, but is more likely at this point. RBC GAM recession model. I don't know what that is, but it's RBC thing. I'm sure we could Google that. Duncan leader indicator fails. Again, they're calling for a soft recession, so this may not happen. Unemployment increases. No, but again, might be churning into the future. Right now, employment is still pretty strong, but week after week, we're hearing more layoffs in different sectors, especially tech right now, because they were fueled by this huge boom in free money. So they just hired everybody under the sun. Now they're just cutting divisions. They're like, yeah, we're not doing that anymore. You're all gone. See you later. This is like, if you've watched any economics, you've talked about real estate, there's cycles, right? So basically they're saying that we're more likely to be late to end cycle and into a recession than we are to be early or mid. And this is just a business cycle. So therefore, we're probably going to see equities slower, business investment slower, employment, economic slack out there, more volatility. And you can see where it's shaded darker, it's going to be more prominent, right? So you're going to see more monetary policy mid to late cycle, end of cycle. It's going to, ease off. Credit's going to be harder to get. Economic trends, housing, just an interesting chart. This is a housing activity. Obviously, this was just silliness here. This is U.S. new one-family homes sold. Well, this is the recession, obviously, right, in the States. But we're still right in here, 2018, 2019, which were strong numbers. We're not back to 2000. We're below 2000 numbers. So it's cooling, right? Obviously, Canadians are spending less on home improvements, and this is a factor of that lumber prices were so high for so long. People were just like, meh, I'm not going to do that. I'm going to do something alternative. And again, I'm not going to use my HELOC. I was talking to a builder friend of mine. He's like, oh yeah, our big projects like 600 to 1,000 to a million, no problem. Still going through. It's the smaller ones, that 100 to 200,000, that a lot of people aren't doing right now because they're tightening their pants. So consumer expectations are falling. Right? Inflation expectations. Everyone thinks it's coming down. Well, why do they think it's coming down? Because they're just going to beat it down with those interest rates, right? You know what? We did get some good numbers out of that, like the PPI, Producer Price Index, which is basically the inputs coming in are lower, so therefore it was down 6% in December. And the only real thing about inflation not is consensus inflation forecast. I think they've done a good job and they got inflation under control, right? So here's the input cost. Input costs are getting less, means outputs less, means that it'll be cheaper. Bond yields tend to peak at around the same level as the Fed funds. So, we're seeing that the US 10-year has been lower than the Fed funds rate. That's inverted. So, therefore, that's a recession trigger. But obviously, the Fed has definitely risen rates aggressively against inflation. Canadian housing drivers. Okay. So they talk about Canada. I think they were more talking about Ontario, but whatever. So poor housing affordability, sharper higher mortgage rates, regulatory tightening, economic conditions. And what's fighting those? This is Ontario and the rest of Canada is high immigration. 100%, there's a lot of people coming into this country that need someplace to live. Ontario and maybe a little bit BC is supply constraints. Just not building enough properties for the people who are moving in. That's why I still see this as an opportunity to buy rental properties in Ontario. Right? Sales to new listings. We're back into a balanced market. So basically, for every house that lists, one sells, one doesn't. Don't really need to go into that. So household debt is actually down a little bit at the end of last year, but it's rising into 2023, and they see that continuing just for the simple fact that when interest rates go up, people pay down less debt. Interest rates go down, they can put more to the principal than they do to interest. So they are seeing price declines, and they actually think, so home ownership costs as a percentage of income has spiked. I don't know if you've noticed, but interest rates are up a lot. They're predicting that to come back down to earth. Well, so we'll see, right? If that happens, what happens in the housing market? Oh yeah, more people try to buy. I know, weird. So you need a higher income in the third quarter of 2022 than you did in 2021. We all knew that. Mortgage carrying costs are up. This is in Hamilton, up 60%. Whereas it was cheaper to own houses in 08, 09, 2010, 2011. And they're going to make that tighter. I don't understand OSFI and why they're going to make that tighter and make more rules. But whatever, who am I? Fixed mortgage rate expectations. So 5-year fixed mortgage rate on the left. 5-year Bank of Canada. Yeah, they're obviously rates are above pre-pandemic levels. But that's just, they've tightened money supply, right? Variable rates obviously are jumping a lot. And you're not getting the discounts on them that you were, like prime minus 1.2, prime minus 1.3. You're kind of not seeing that. It's really tight right now. Projected price drop would surpass prior corrections. I think that's already happened. From the peak to the trough, I don't even think we're in the trough maybe just yet. I think we're close in Ontario. Yeah, I mean, we've had 35-40% decline. Like that's, yeah. I mean, this again, Canada is so regional. That's why you got to look regionally, and that's why I invest in Alberta as well, because regionally, Alberta is super strong. The rest of Canada goes into a recession. I don't think Alberta will go into one. US 10-year, surprisingly expensive. Anyways. I mean, at the end of the day, what are they trying to say? they were trying to, or they are telling us that they believe that we are going into a recession. So 70% chance we're going into a recession this year, if we're not already in one. But they're calling for a very light recession. So very small negative growth over 2 quarters, maybe 3 quarters. They are calling for employment to still be strong. And this is really an interest rate driven recession where it's going to be, okay, it's going to cost me that much more to do something. I'm just not going to do it right now. I'm not going to spend 9-10% to get an auto loan, which then triggers a whole bunch of other things. But at the end of the day, I think we're going to come out okay. I'm still looking at real estate right now. Obviously, just bought another property in London and looking to buy more. So if you guys know of any things that haven't hit the market yet, definitely reach out to me. Happy to look at properties, multifamily in Ontario or Alberta. And yeah, thanks everyone for watching. Have a great day. We'll catch you next time.